On this episode, we talk about investing with leverage, the first ever Bitcoin ETF, and is investing easy? Welcome to episode number 7 of Think at Heart.
All right.
Okay, nailed it.
Number 7. It's a good number.
Number 7, lucky number 7.
It's a good number.
Oh, feels like we're getting going on these things.
Yeah, I think so.
You know, getting some good feedback.
Yeah.
The viewership and the listenership is growing.
Yeah, absolutely. We had lots of interest on that RSP, TFSAs, crypto one. Lots of interest in that.
Yeah. People love to be interested about all the boring stuff.
Before we go, I think we the last couple of times I think we forgot to mention disclaimer. I don't know that I'm gonna have it word for word, but before we get into this, especially after watching the gentleman on Reddit speak to the House Committee in the U.S. today. Very important for everyone to recognize that any information we provide today is for information purposes only. If you have any questions, contact your financial advisor. We're just providing information and how we see it. Okay.
Again, super boring. That's the boring part. All right. And we are the advisors, by the way. So they should contact if they have us directly, and we can answer all their questions. Okay. Contact information down below in the description. Okay. Let's get started. We got a lot to talk about. Let's start off with talking about some things in the news that we're really excited about.
Okay.
The first ever Bitcoin ETF. Why don't you give us the rundown on that?
Yeah, well, listen, it's super exciting that Canada gets to be the first country, the first index in the world that launches an ETF. So an ETF, for people that don't know what this is, it's an exchange traded fund. So it's something that you can buy in the TSX. And so up until now, there's been closed-end funds that you can buy. So there's been a few, 3iQ, CI, and Sprott. They've all launched closed-end funds. And so there's a couple of things. An ETF and a closed-end fund, there are a couple of different vehicles. A closed-end fund is something that's like a mutual fund that trades on the market. Oftentimes there's a difference between what it's trading in at the market and what it's worth. So sometimes there's a spread between what it's worth and what it's trading at. Where an ETF, the ETF has the responsibility to keep the price kind of tagged to how it's trading in the market right now. Gotcha. Yeah. So Purpose Investments, they're the ones that won the race. They launched it today. $200 million in assets went into that today. It's a big number, especially for Canada. So that's a big deal. Yeah.
So how do people get into that if they want in on it?
Yeah, so you can buy it through any account. Basically, you have TFSA investment account. If you have an account with your advisor, obviously they can go and buy it now. If you have an account with a discount, like an Interactive Broker or something like that, you can go in and buy it. I mean, you can spend $1 or $2 depending on how much money you have invested in Interactive Brokers. As an example, you could go in and buy it there, but you can buy it in your TFSA and your investment account and your RSP. I mean, it's eligible to be invested in any type of account in Canada, right? Well, and for the world, for that matter.
Right. So up until now, it's really been, I mean, the main way people buy crypto was through kind of those independent crypto exchanges. Is exchange right the word for that?
Yeah.
Right? Like a Coinbase or in Canada here, it's CoinSquare is the big one.
Yep.
What's the difference between buying it like that and buying now the ETF?
Yeah, so everyone's going to look at it a little bit differently, but some of the purists would like the Coinbase or the CoinSquare from the perspective that you retain ownership of that, you own that, you can take delivery of it technically. So there's some like fighting the system, independent, decentralized. You know, the downside of that is the huge spread, right? So if you're going to go in and buy and sell Bitcoin on those exchanges, you're going to pay a pretty big spread between what you see on your CNBC or whatever you're watching to track your Bitcoin cost, and what they actually let you sell it for. So they're going to take a big percentage. I mean, it used to be huge, it's narrowed, but it's still a multiple percent to buy and sell on that exchange versus buying the ETF. You know, you're going to pay, well, technically you're supposed to pay what the net asset value is worth. So whatever purpose is buying the Bitcoin for, you're going to pay, essentially what the bid price is for it, or the midpoint. And so, you're going to be able to buy and sell it for $1 or for free if you're in the US. I mean, a lot of the US brokerage firms allow you to trade for free now. So you'd be able to technically be able to buy it and sell it for free.
Yeah, I think that maybe the upside, like you mentioned, for keeping it with the crypto exchanges are like you take delivery of it, right?
Yep.
Like
Yep.
you can actually physically get and hold it in your digital wallet if you want to. I mean, I don't do that. That's where I own crypto. I don't mind saying that here, because that was the only ever way to buy it, right? Up until now. So. But yeah, it should be interesting. I mean, at this point, it seems like every piece of news for Bitcoin is positive, right? I mean, there's still like the people that are coming out saying, oh, this, there's a lot of risk here, whatnot, but it's just more and more people like BlackRock this week came out and said they dabble in it, which tells me they're all in on it, right? That they've started to dabble in it is what they've said, right? And a company like that keeps everything close to their chest, the fact that they dabble in it just tells me that they're all in on it, right? And I say that with cautious excitement from a standpoint of, things like this are usually too good to be true, usually are, right? And there's always a beginning and an end into whether it be any investment or business, like we talked about in the last podcast.
Yeah.
Right. There's always a cycle of things. There's going to go out. There's going to be a correction, right?
Of course. Yeah.
But it just seems like, they're talking it's going to go to $1 million a coin in the next decade, or if that's the case, I mean, there's going to be a lot of happy people that are getting in now, right?
Yeah. So look, it's I because I've gone through a lot of bubbles and lots of different things that I've seen happen. This one is interesting for sure. But when Amazon was trading at a couple of dollars after they got the crap beat out of them in the 90s, nobody said that they thought Amazon was going to be the first $1 trillion market cap company and trade at the levels like it is. It was a long, slow road to get there. And so can Bitcoin get to $1 million a coin? It certainly can. But it's definitely not a straight line.
No.
Yeah. And so it's a high beta, high risk asset. There's no part of me that thinks it's a currency like, or an alternative to gold. I mean, gold's a high risk, high beta asset too. So I think it definitely has still potential ahead. But this kind of everybody think it's going to go up scares the crap out of me.
Yeah, exactly. Yeah, I don't know. I mean, better than anybody. I I've owned it for 3 years, and I just basically forgot about it for 2 years, right? And then it started headed up a rope pretty much, right? And got my attention. But now, to be honest, it seems like we talk about it every week and we keep saying we're not going to talk about it anymore, but you can't not. Right? Like, Raoul Powell is saying that it's probably the investment of a generation. Would you agree with that?
Well, yeah. I look. There's still a lot of unknowns, but I've never seen anything like this.
Yeah.
Yeah, in my career. Yeah. And, the only, I think, other comparison is probably gold. And, that probably sounds a bit ridiculous right now to compare it to that. But, in the 70s, the only way you could buy gold too is from a gold dealer or something like that. You had to buy physical coins. There wasn't a way to trade it or transact it. The institutions didn't own it because there wasn't a way to do that till the first gold ETF came out. And then what you had is you had a massive squeeze as all the institutions said they wanted to have an allocation to gold in their portfolios. And you had, a blow off top in gold. And then you had decades of nothing with it. So we could have a similar type of action with it. Obviously, this one has a technology tilts to it, which makes it a bit different. But I think there's quite similarities to kind of the structure of it.
Yeah, guys like that say, Raul, who's a macro guy,
Mm-hmm. Yeah.
that's he said a similar thing. He's like, well, I'm kind of getting sick of talking about it, but he said I can't even look at anything else because the investment is just too good. Like I can't convince myself to invest in something, take my money out of Bitcoin because I think I'm going to get a better return on something else.
Yeah.
Right now.
Yeah.
Right.
Yeah. Yeah, and so look, we've talked a little bit about Raul. Like he's a long-term macro trader, and like macro investors take a long duration view. And when you've listened to him too, he said, the one advantage that I have, Raul has as an investor, is he's got time. He's got that time value to stay with a position. He's not managing money. He's not got his feet to the fire like a hedge fund or like a manager like me, where we got to deliver now. Yeah. So I can't say to a client, yeah, well, Bitcoin's going to $1 million. Yeah, it might drop 50, 60%. Don't worry about that. We're still going to $1 million. People are going to say you're out of your mind.
Yeah, for sure. Yeah, no, I totally agree. Agree.
Yeah.
Which actually brings up it's a good transition to our next topic. Like when you see, when we're at a time like we are right now, where there's a lot of volatility, it almost seems like it's easy to make money. There's all these great investments that people, when you hear people say, oh, it's an investment in a generation.
Yeah.
There's lots of opportunity out there to invest with leverage now, right?
Yeah.
To lever up, put all your money. Interest rates are low, so you're bound to outpace those.
Yeah.
Right. If it goes the right way for you.
Yep.
So in what situation do you think you should use leverage to make investments?
Yeah, leverage is a tricky one for sure. I think that there's multiple ways to leverage, and so I think about leverage from the perspective is I often get that question about investing in real estate versus investing in the market. And so, I'd kind of start with that as kind of the backdrop, right? Because a lot of people in real estate want to talk about the fact that, housing prices have only gone up, right? Because they scale it back and they look over 25, 30 years. They never look at like a minute time frame. But the one thing that never goes into that calculation when you're investing in real estate is you get massive leverage, right? Most people now we're talking about what's happened to the real estate market in Ottawa. So, okay, you bought a house last year and it's up 100,000. Okay. So, maybe you invested 500, or you bought a house for 500,000. Now it's worth 600,000. And so the thing that people look at is they go, well, you know what? I put down 5% on that house. And so now my 5% is actually worth this. The factor you didn't get is you got 95% leverage on this thing. That's why it went up. That's why you made $100,000.
Yeah.
Like if you invested $500,000 in the market and you had 95% leverage, the market would have kicked its butt. Right? Yeah. You'd have a lot more money.
Yeah.
So investing for leverage is a tricky one. And the difference with real estate versus the stock market is, you can do it in a couple of ways. You could do a secured line of credit, for example, where you get a fixed dollar amount and then you put it into the markets. Mm-hmm. Or you could do what's called a margin account. And so what a margin account is you have a certain amount of money invested. We'll say you have $1 million invested in your portfolio, and you decide you want to have it invested in a margin account. So what you own within that $1 million portfolio, say you own a bunch of different stocks in there, and let's just say they're all high quality stocks. Those high quality stocks will give you 70% loan value. So you'd actually be able to invest 1.7 million in a stock portfolio, and so you'd be taking leverage there. The challenge with that one is that the market is live; it's daily. So if the prices come down, you have to put more capital into that portfolio to continue to allow it to grow.
Well, that's right. And it's not like, oh, you have time to do that. You need to do it by the end of that day.
Yeah.
Right? Like you don't, otherwise they can sell you out of your position, right?
That's right.
Not only they can sell you out of your position, they have to by law sell you out of your position.
Right? That's right. Yeah.
So to me, it's a lot, it would seem a lot riskier. I mean, but like anything, it's, risk and reward there, I guess, right?
So it is riskier. I mean, there's other ways you can do leverage too, right? So you could trade options, and that's leverage, right? So you could say, I like Visa, for example, and I'm willing to allocate $10,000 of my capital to Visa, but I want to do it in a leverage format. So you got a couple of choices. You can say, I'll put $10,000 in call options. And so you're going to get maximum leverage there because you're buying, options which have a set expiry date, but you're getting leverage, like crazy max leverage.
Right.
Yeah. And so then if you want to go on top of that too, there's triple ETFs that give you triple exposure to a certain asset class. Yeah. And then you can buy options on that too. So you could get like 50 times leverage on something like that.
Wow.
So, yeah. But those are all definitely things that I don't recommend, but there's ways to lever up portfolio.
Yeah. Well, and I mean, options it was like a perfect example of that is the whole GameStop thing, right?
Yeah.
That's exactly like shorting and whatnot is
an
example of that. And that's the thing, right? Like people lever up to kind of swing for the fence and hit that home run.
Yeah.
But when it doesn't happen, right?
Yeah.
I mean, the worst thing that it can happen is that it does happen, right?
Yeah.
Like what's your saying? What's your saying about your first time investor? Like the worst thing that can happen is
you can make money on your first trade, make lots of money on your first trade.
Yeah, exactly.
It's the worst thing.
Exactly, because then you just think, oh, stocks are always going to go up, right?
That's right. Yeah.
Right.
And it's worse if you do it on options, right? Because if you hit a big pass on an option, you're like, that was easy, and you could obviously evaporate your whole amount of capital with options because there's a time value. So if you put money into an option contract, it expires out of the money, you get zero.
Yeah. I mean, like even when you talk about margin, I mean, my concern with that is like you need that same amount of liquidity on the other side, because again, if something goes wrong, you need to be able to meet that margin call, right? So you need to have that money readily available, I guess, because it's due on the same day. Am I wrong about that?
Well, look, there is a requirement by the firms to request additional capital, and depending on the net worth and the client and their ability to meet previous margin calls, they may give them a bit of time. But there is a requirement that the firms make good on those margin calls, and I've seen things certainly in my career where they've forced, and we've had to take action for people that are in margin calls. And obviously it doesn't happen in the good times, it's always in the bad times. So yeah, you got two choices, and put more capital in or we sell your stuff.
So you've seen that in your history before, where you've had to sell people out of their position. You've had
Yep.
that. Huh?
Yep.
Do you
Yep.
have any good stories about that? You know, I mean, you could tell a story. You don't have to put names.
Yeah. Look, I've had a couple in 2008, and then actually last year as well. Um, the one last year was the most difficult because the portfolio had gone from somewhere in the mid 1.5 million down to basically 150,000. And I had to say to the client, listen, this is it. We have another couple of days like this, and your portfolio is zero. You're going to owe the firm money. So if you don't take action now, the firm's going to liquidate your portfolio and you're going to have nothing. So you either need to sell something now, or you will effectively have run out of money.
Wow.
Yeah.
Wow.
Yeah.
That must be a tough conversation to have.
Yep.
But that's
that's it. No, look, it's a tough conversation to have, but you know, it was the right decision because he agreed to it. We did it. The portfolio has recovered significantly. Not back to where it was, but had he not done it, he would have had nothing. And so, you know, it's if you want to take leverage, you got to be willing to take the pill and make tough decisions at the right time. But it's not a fun one.
Yeah. So speaking of that, I mean, speaking about the ups and the downs, obviously there's a ton of volatility in the market right now, right? And as we've talked about before, you know, volatility used to be the indicator of fear. Well, you don't think that's the case anymore, right?
I don't. Yeah.
But what I mean, there's so much volatility in the market, right? And it seems like every day that there's something different. So why do you think that is?
You know, I've had a number of conversations. Clients have asked me about volatility, and it stayed elevated. And so I think it's been, you know, as I've watched it and as I've thought about what it means, you know, I think it's become the inverse, right? You get as the markets are going up and volatility is going down, you know, that tends to mean that there's something kind of lurking below the surface. And we've had many days here in the last couple of weeks where we've had volatility up, we've had the markets up, we've had bonds up, and so those things don't relate anymore. And so, yeah, I think as you look at kind of the construct of volatility, is you've had a lot of institutional managers building portfolios with volatility as the single guiding factor in how they make decisions, whether they lever up the portfolio or lever down it. And so they end up trading volatility to try to manage the risk within that portfolio. And so it's completely skewed out that kind of fear gauge. And I was listening to somebody on Real Vision saying, you know, their view is it's kind of the greed gauge now, right? So it's not the same indicator that it was at one point, and you get huge amount of flow towards kind of trading volatility, and so it's kind of skewed out that volatility complex, and it doesn't mean as much as it did anymore. And I think it's more important to, I guess, follow the rate of change of volatility as opposed to that static number. You know, I used to be conscious if volatility is trading in the mid 20s, the market must be fragile. Well, I don't really think that applies anymore. I think you get much more trading around these institutional managers trading around VAR, which is a value at risk. So they're trading with this kind of risk mandate, which you know, doesn't really relate to risk anymore.
Mm-hmm.
Yeah.
Is volatility? I mean, volatility is good for trading, right? Like it's not the best for long-term investing, but it's great for trading, right?
Yeah.
That's what traders want to see is kind of that, because the volatility is really opportunity, right?
Yeah.
To make money going up or down, right?
Yeah. It is. Yeah. And I guess, you know, as I think about hedging, right? And that's as I do, and that's something that I think about. Like last year, as we got into February, basically a year ago, you know, we hit February 23rd, I think was the day the market started to blow off. But when I bought put options on February 14th last year, volatility was like 8, historic lows. I mean, if you're hedging, that's fantastic. Market's at an all-time high, volatility is at an all-time low. Options are super cheap. So I guess when you're thinking about what it is that you want within a portfolio, but volatility is not a bad thing. To your point, it's oftentimes looked as a bad word. It's not a bad thing.
Yeah, I think people are learning how to manage it, right? Like looking for the opportunity in those types of things, right?
Yeah.
And I think it goes back to, I think people are just, even with everything that's gone on over the years, I think people are less afraid in general, right? People are more afraid in the world of where it's going, but I think people are less afraid to take risk is probably the word that I'm looking for, right? People take lever up, take more and more debt, right?
Yeah.
Because they don't have that same fear factor, right? Same thing with I lost it. Sorry.
Yeah. No, for sure. I mean, I think it's a fair point that I think people's views have changed, and that's, I guess, this trending market will do to you is that you think you can, you think you know something more than the market, but so you can take more risk, you can lever up the portfolio, and you'll be fine. Someone will bail you out.
Yeah.
If you're wrong.
Yeah, and I just think that's the
Psyche.
sentiment of the generation, right?
Yeah.
I think people are just less afraid now. Okay, so that brings us to the next point, which is times like this makes investing look easy, doesn't it? Okay? Like Davey Day Trader got in like a year ago or whenever he started investing, and he's like, stocks only go up. Right? Because it just seems like whatever you put money into, it's just going to go up. And I think too, like with a bit of a crash last March when COVID was first hit. So if you started to invest at that time, then I mean, you've made out wonderfully, right? Like everything has kind of gone up from that point, right? That's the opportunity that people recognize, right? So so what do you say to people when they think, oh, I've been investing for last year. It's just super easy. Everything I put money in and it goes up.
Yeah. I mean, look, everyone has the value of hindsight with a lot of conversations around that. We knew this was going to happen. That's a lot of the conversation, but investing is hard, just like everything. You want to be successful at whatever you do in your life. You have to work at it. Often we have these conversations with my kids all the time, as I'm sure you do too. They're like, they see somebody on TV and they're like, wow, they're so good. How'd they get at it? They work their butt off. They work at it. Right? It's not easy, but there's this kind of overtone that's in, I guess, the media and press, and a lot of these, these passive, we'll call it ETF strategies, or like the DFAs of the world. They're looking to make things easy. They want everything to be easier, but investing isn't easy. You got to get up every day. You got to look at what's happening in the world and the markets. You got to take a look at what's happening in the economy, in politics, and then you have to decide on what you're going to do that day. And it takes time to learn that. You got to put in the reps. I think that if you want to be average and you want to be an average investor, then you can buy an ETF model, you can buy a mutual fund, and it'll be average, and you can choose that path. But if you want to be good at something, it takes a lot of work.
Yeah, for sure. But let's be honest, the average person who has a job, not in the financial sector, right? And that, they want to make a lot of money, but all they're doing is reading the headlines and they're not really digging into it, right? I guess their option is to find an advisor to do that, right? Is that what it is, or?
Yeah, I mean, look, if you're gonna find an advisor, like if you want somebody that does something different, then they're gonna look for somebody like us, like somebody that does and makes decisions differently than the average person.
Right.
So, I mean, if you're comparing but you're comparing like a, portfolio manager that tracks the models that the firm builds for them, you could do that, or you can buy an ETF. They're basically going to be the same things.
Yeah.
So if you want somebody to do something different, then you have to find an advisor that does something different and find out what value that they add to the portfolios.
Right. Exactly.
Yeah.
Exactly.
Yeah.
Yeah. I mean, a lot of people get into investing right now too, and it's not, I don't want to say it's not that hard, because there's still a lot to consider, a lot of information to consume on a daily basis, but
Yeah.
it's not, it's not that hard. You can put money in, and it'll grow for the most part, right? If you invest smartly. But it will come a time when it's not like that anymore, right?
Well, yeah, it's not. I mean, look, the obviously last year when we had that big sell-off in the markets, you get what happens at that time is people sell, they panic and they sell. They don't make the right decisions in the irrational time, and so right now again we've reached that other end where things are starting to get a little bit irrational again, and so people are making those decisions where we can continue to stretch a bit, and we can continue to push a bit because we're reaching that other end of irrationality. And so, when you look at the historical data, you look at mutual fund performance, because everyone hates mutual funds, right? So you look at that and you look at mutual fund performance in aggregate, and their performance has been pretty good. But then you look at the people invested within those funds, their performance is quite a bit worse, is because people buy at the top and they sell at the bottom. And so, if you had held a simple mutual fund and you held it for 25 years, you probably would have done okay. But inevitably, what happens, whether it's the advisor or the client, is the market runs up. You probably buy somewhere around these levels because you want to buy last year's 5-star fund. Obviously that's what people sell. This is the greatest fund. So you buy the 5-star fund that turns out to be a 2-star fund by the end of that next year. You sell it and you buy the next 5-star fund. And so what ends up happening is you cycle yourself constantly out of the losers, and you have your performance tends to suffer.
Yeah. I mean, so like, why do you think people do that? Why do you think, I mean, the psychology is so many people buy at the top and sell at the bottom, which is the exact opposite of the way it should be. And everybody knows, right? Us included, we know you don't, if it's going down, you don't want to really sell it at that time.
Yeah.
Right.
Yeah.
I mean, there's obviously situations where you
sure.
do.
Yep.
But you just know, like, you would just want to press that eject button so bad. Right?
Yeah.
You're like, no, ship's going down. Get out of it. When if you just held it for another, few days, you'd be back on it, right? I dropped you. Can you hear me? I lost you.
Are you back with me? Sorry, I lost you there for a few minutes. We do it because it's just human nature. And so what happens is what the market should do is they should just mark prices once a month. You mark prices once a month. If I came to you, Scott, in the middle of February last year and said your stock's down 50%, you'd be like, crap. But then the middle of March, say your stock's back to where you bought it, you would have been like, okay, that's good. Yeah. But what you're gonna do is you're gonna say, I can't take it anymore. I just can't take it anymore. Yeah. I just can't take it anymore. Like that, the amount of conversations you have that's what people say. And so it's so hard. And I think that it really is this FOMO. It's this fear of missing out. So on the other side, the thing that I've done most in my career is I've sold a little bit too soon. And that's as hard to watch. I exit a position that's up 100%, it goes up another 100%, and then it drops below. But that next move is the psychological killer.
That would kill me. You missed that other 100.
Yeah. But the thing, it's true. But the thing that I've learned and that you have to know that there's tens of thousands of stocks you can buy out there.
Yeah.
So, you go into a position, you buy something that, that's gone up 100%. You switch it into something else that you think has a similar risk reward. So, if you're right on that, obviously it works out. If you're wrong and the other thing runs and that just stays flat, that's fine too. But it's the fear of missing out, and that's a train. Like it's the reps, right? It's the training. You have to look at it. You have to say, I'm fine. When I bought this stock, I thought it could go to here. It's here now. Has the world fundamentally changed? Probably not. So I'll take my profits, go home, and move into something else.
Yeah, for sure. Yeah, I mean, here's the thing. You know what I've realized since I've been in this game is that people want the upside, but they don't want the risk of the downside.
Yeah.
So the opportunity to make more money does not trump their fear of losing their money. Right? We see it often with a lot of our clients that just want the regular risk profile. You know what I mean? The conservative risk profile.
Yeah.
Right. And understandably, depending on where they're at in your life stage, right?
Yeah.
Right. Because you can't afford to take that risk because they got to live on that money the rest of their career, right?
Yeah.
But they love the upside, don't they? Right?
Yeah. Everyone wants max upside, min downside.
Yeah. So why do so many people just go into mutual funds, and like there's such a small return on those, right? Like the 1 to 4% when the opportunity is out there to deal with advisors like us that trade on a regular basis that can have much bigger returns than that.
Yeah. It's easy for them. And it's decades of like selling, of the firms selling that you should own mutual funds. You should own diversified mutual fund portfolios because you're a small investor, and that's the only thing that you should do or can do. And so I think a lot of it is that kind of psychological selling. And there's a lot of thinking around diversification. And so I think diversification is still important, but you need to know what you're diversified in. And most funds are built on 1975 diversification rules, and it's 2021. And diversification rules are a lot different today. Right. So it's just easier for people. They'll go into their bank and the banker will give them their 5 options. Are you income? Are you conservative? Are you balanced? Are you balanced growth? Are you aggressive? And human nature is, I'm going to pick one of these. I'm not this Nancy at this end, and I'm not this aggressive, crazy gambler. I'm going to pick this one in the middle.
Yeah. Definitely see that a lot.
Yeah.
Oh man, I don't know. I feel like this has been a very serious conversation. Like we've kind of got right into the weeds today.
We did.
I know we don't normally go right there.
No.
Almost. Last week we had a lawyer on. Today we're getting all serious. Hey, what's the podcast coming to?
I know. Well, we got to keep it light if we want people to watch it, but we also have to realize that we're not super light all the time.
Not all the time.
No.
We're light when we want to be.
That's it.
We have to be.
Yes.
All right. How do we want to close this up?
Well, have we? I don't think we've gone into the discussion really around on where the market's going, where the world's going.
Better do that then.
Yeah, I think
so.
Look
at me, I'm just trying to get out of here.
Well, we can wrap it. It's been it's been So I'd say the last thing which we talk about just will continue to hammer on the kind of the markets and what they do. I look at a day like today where the markets were down kind of across the board. I see red across every major indice in the world. but then I look at some individual stocks, and you look at certain things. You look at like a Container Store up, it was up 15. Finished the day up 12%. You got Twitter up a percent. You got Ethereum was up. You got some of those consumer discretionary names that I mentioned. Porsche was up. And so, I think it really makes a difference what you own at different times of the markets. And so, when you get a down day, you have to look at it and say, what's the market telling you, and what do you do to make sure you're taking advantage of these kinds of activities. And that's where you have to keep working at it if you want to be consistent. And so, the market's open, so many trading days each year. And so when you get these kind of down days, you have to be able to be prepared for buying good things and putting the portfolios in good shape.
Yeah, I mean, it seems like when we have one of these down days, it just it seems like it's the next day it rebounds, right?
Mm-hmm. Yeah,
we're not getting sustained amounts of downward pressure, right? Like, are you seeing that?
Yeah. So that all goes into Keith's quad 2, right, version, where we're getting growth plus inflation. You're looking at the other fundamental indicators, and I mean his structure has been built off of of uh, uh, volatility, volume, and inflation. So, volatility's down today, volume's down on a down day. Both of those are signals to buy the dip. Right? If you get volatility up, you get volume up, that's a signal to say, hold on,
Right.
I'm not sure where we are. So,
Right.
so when you get volume and volatility working together, you get stocks coming into a range where you want to buy them. Like those are all go signals.
Right.
Yeah.
So what situation where you see where it's the opposite, where you see more down days than up days, right? Like you have a sustained period of where the market's just going down, and
Yeah.
then you get one day where it rebounds, right?
Yeah.
And
Yeah.
then another sustained period where it goes down. Like in what situation do you normally see that?
Well, from a macro perspective, you see slowing growth and slowing inflation. So you get the quad 2. You get slowing growth, slowing inflation, and that kind of action tends to be a period of time where you're in recession. And so that type of action is where you're going to get those trending down moves in equities. And so, I mean, the inverse of that is trending up move in bonds and US dollar. So, those two things kind of play off against each other. And so, I've had lots of conversations too with clients. Some clients have some gold exposure. And so every time I talk to them, it's, my focus is on what's happening in the US 10-year. We always come back and they say, well, who cares about the US 10-year? I'm talking about gold. Well, if you look at what happens with gold and interest rates, particularly the US 10-year, when the US 10-year hit its low last August, gold was hitting its high. And so since then, you're going to get those inverse correlations. So, you'd be looking at something specifically and say, when that 10-year rolls over and starts to go in the other direction, gold's probably going to start to move up. And so when gold rallies, we'll call it those, like your question is, when we get a day where gold, like silver, got squeezed by Reddit there, it was temporary because yields were still rising. If yields were falling and gold was rising, well, then you'd say maybe we're starting a new trend.
Right. Gotcha.
Yeah.
Another heavy answer, Ben. Another heavy, like in the weeds, technical, like 3%.
Just because it is. Right? Just because it is.
3% of the people listening to this will even understand any of that. And I'm not part of that
3%. So I'm targeting my engineer friends.
Oh man, I guess so.
Or my economist friends, or someone that likes to get in the weeds.
Yeah, for sure. Well, we have lots of those types of clients, don't we?
Yeah.
So, get in there with you and muck it up.
That's it.
Okay?
That's it.
That's funny.
Yeah.
Cool. What else you got? What else is going on in the world? that we're looking at, interested in?
Let me see what else I got. I really am looking for the trend change, because it is the thing that, because investing is easy right now, as you say, and because many things are going up, and because my view is we probably have a rough kind of mid patch or the second half of this year. And I think we get into that period of time where we get maybe some recessionary prints in the world. I'm spending so much time trying to see what that signal is. You're holding on right now, and we talk about, Bitcoin, and we talk about how the positioning on it. At some point, it's going to have to be sold.
Yeah.
And so, and a lot of these things that I'm owning and buying now, a lot of these companies that I like and buy, I'm going to have to sell them. And I hate that, because they're working. It's doing great. Yeah. But at some point, you're going to have to sell them. So I'm spending time looking for those signals.
That sounds hard. Hard. Anyone, especially when everything's just going up.
Yeah. But that's it's the difference. It is the difference maker, because when I talk to a lot of people, that's historical view that we can just buy and hold and everything's going to be fine. If you bought and hold the TSX last year, people want to talk about this. They'll say, yeah, my portfolio recovered. Okay, yes, you made 2% last year. Mm-hmm. So, you had $1 million invested. Your $1 million goes down to, we'll call it 600,000 at some point in the year, and then it recovers and it goes up to 1,020,000 by the end of the year. So, yeah, buy and hold is okay, but you have a hell of a ride, and I think that that's not going to be the way to make it happen for you as you look ahead and where the markets are going. And I think you have to take a view that you're going to adapt to what the world is doing, what the markets are doing. So I don't think you can just buy and hold and go to sleep.
Yeah, I agree.
Yep.
Cool. So let's talk about what we have coming up with the podcast soon.
Okay.
What are we looking at doing? I think a couple things is we talk so much about crypto and Bitcoin, and we keep saying that we don't want to focus on it too much because we don't want to become that type of channel, right? Like, we're not crypto guys by any means. There's so much interest around it. It's hard not to talk about it all the time. So what we want to do is we want to bring an expert in to really kind of get in the weeds with you, as you like to do, and kind of break it down for people to explain exactly what crypto is, what the blockchain is, and what the opportunity is as well. So I think we'll have that as a guest coming up in the next couple of weeks. We've also got Jessica has agreed to come on and do some more information on the states and just overall lawyering. I call it. I just made it a verb.
Lauren. Yeah, she said she wanted to give us some of the worst cases she's seen.
Yeah,
that should be fun.
Exactly. Case studies are always great. That's something I think we should do. And more on this is tell stories.
Yeah.
Right? Tell stories of things that you've seen happen, both good and bad. Right.
Yeah. Yeah.
I know we can't say specifically what happened, and we can. It doesn't even have to be necessarily your experience, but things that we've heard or case studies that we've read or something like that. Because I think that's interesting, and people can learn. It's really easier for people to understand concepts through stories like that. So definitely looking to bring more things like that.
That's a good idea. I mean, I got lots of things that come to mind where I've seen the best and the worst and the decisions. And so, part of how my view and my thoughts have formed is based around that. So that'd be good. Yeah. So also we're going to have an accountant come on and talk about taxes.
That sounds super boring.
So that's super boring. What else do you want? I've been talking with someone that is an expert in central bank digital currency. So I think that would be pretty weedy, but could be super interesting to to bring that kind of view. They've worked with the Bank of Canada before as well, so it could be interesting. See if we get them on, see if we could convince them too, because I think that'd be a pretty unique perspective.
Yeah, no,
yeah,
I think that would be interesting. Probably, again, like you said, probably over most people's heads, including mine.
Yeah.
But yeah, that could be interesting. Not boring.
No.
Not boring.
Right.
Accountant, boring.
Yes. Yeah.
So anyway.
lots of things we're working on.
Okay, good.
Yeah.
All right. Well, let's wrap it up. Episode 7, Think It Heart, crushing it in the market for the clients. If you want to contact us, contact info down below. New website coming out soon, heartinvestmentgroup.ca. Don't go there now because there's nothing there. But that's coming out in the next couple of weeks. And we're just crushing it for the clients thanks to Mr. Ben. Okay, that's it. Thanks for tuning in. We'll talk to you next week.
Sounds good. Awesome. Thanks.
Turn off the recording.